So the light is still not around.
Yes, sir.
Good morning to you all.
Good morning, Lord.
And welcome to today's lecture. I hope you can hear me.
Thank you. Yes, please.
Now, this morning, we shall be looking at financial reporting 1. So, since it is financial reporting 1, then obviously you will do financial reporting 2 as well. So this is our outline for financial reporting 1. After the lecture, I will share it with you so that you can also read more about what we are going to do for the semester or for the block. So this week, which I have termed as week 1, we are going to look at the regulatory and conceptual framework for financial reporting. The regulatory and conceptual framework for financial reporting or financial statement. So it is made up of 3 parts. We will look at the regulatory aspect. We will look at the conceptual framework aspect. And then we look at the ethical framework. So these are 3 major things that we're going to look at. After we are done, then how do the standard setters set standards? So the International Accounting Standard Board, they are responsible for setting accounting standards. So we will look at the process that they follow in setting up the standards. Then we shall also look at the International Accounting Standard number 1, how financial statements are prepared. How financial statements are prepared. Then we will also look at fair value measurement. So if we are not able to get to the fair value measurement, obviously it's going to be a reading assignment for you. And you should be able to go through it. And we will discuss at our next meeting. Apart from that, our next meeting, we will look at various accounting standards. There are various accounting standards that we are going to look at. We will look at financial instruments. And these financial instruments comprises of 3 different standards. The financial instrument comprises of 3 different standards. We will look at IAS 32, IFRS 7, and IFRS number 9. IFRS means International Financial Reporting Standard. They are all standards. International Financial Reporting Standard. That's the IFRS. And then we will look at in week 3, because all these are on the financial instrument. All these are on the financial instrument. So week 3, or the 3rd meeting, we will look at IAS 16. And IAS 16 talks about property, plant, and equipment. Property, plant, and equipment, which we call PPE. Then we will also look at investment property. This will be catered for in week 3 or 3, the 3rd meeting. Then our last meeting, we will look at IAS 38, intangible assets. And then we will also look at IAS 36, impairment of assets. Impairment of assets. So we have also added some course materials that you can get access to and get more information. So remind me, course referee, if you have joined, remind me that I'll also send you the ICAG manual, the Institute of Chartered Accountant manual, so that you can read that one. It will serve as your main text that you can make reference to. The ICAG manual, I will send it to you to remind me after the lecture, so that when I'm sending the slides, the course outline, I will also send you the ICA Ghana manual, which will aid you as your reference point if you want more information on any of the things that we are going to discuss. So in a nutshell, that is the course outline. And I've said earlier, I will share with you after the lecture. I'll place it on your platform for you to get access. All right. I hope it is clear.
Yes, please.
Very. So I want to share the slides now so we can all look at what is there for slides. So just a minute. Please, can you see my slides?
Yes, Doc.
Very good. So these are what we are going to do this morning. The financial reporting one, and those things that I mentioned earlier, the regulatory framework, the conceptual framework, and the ethical framework of financial reporting. That is what we are going to look at. And I did mention that it is of three parts. You look at how financial reports are regulated, and then the concepts that they employ in the preparation of these financial statements, and the ethics that they have to adhere to make sure that the information that they are providing for the users of the financial statement will help the users make an informed or economic decisions. So the very nice beginning, and I crave your indulgence to follow, and where you have any doubt or misunderstanding, we can iron it out. But it's not difficult at all. So we will look at what we have to achieve, what we have to achieve at the end of the lecture, and the learning objectives is what you see there. First, we are going to discuss the need why we should regulate how financial statements are prepared. Then we will look at advantages and disadvantages, describe the International Accounting Standard Board, how they set standards. We look at the conceptual framework, and we also look at the ethical framework. We will look at IAS1, the format for the presentation of financial statements. And then, like I said earlier, if we have time, we will discuss the provisions that is contained in IFRS number 13. IFRS number 13 simply means value measurement. It is for value measurement. How do we value or place measure on values? So either using historical cost, either using present value, either using current cost, or using replacement cost. So how is fair value determined? So we will look at that one also. Now the question is, what is accounting information at all? What is accounting information? Now, when the preparers of these financial statements prepare their accounts, the essence is that there are people in whose interest that the financial statements are prepared. And those people will have to use the financial statement to help them make an informed or economic decision. So the overriding objective of preparing the financial statement is to enable the users of that financial statement to make useful economic decisions. And how will this financial information or accounting information help the users to make an informed or economic decision? To be able to do that, then the information so prepared and presented to the users must be backed by some regulatory regime. They must have some regulation backing how the financial statements are prepared. There must be some concepts that they have to take into consideration in preparing the financial statement. And then there are some ethical requirements which the profession enjoins all members to adhere to when preparing the financial statements. So accounting information aims at enabling the users to make informed economic decisions. So the overriding quality of accounting information is that the information will help the users to make useful decisions. It's very, very important. Now, let's take them one after the other. The regulatory first, then we go to the conceptual, and then we go to the ethical. Now, when we say the regulatory framework, now the name to regulate something, that is how to regulate. So the regulatory framework will describe the laws, the principles, the rules, and the regulations that govern how businesses record transactions and then report on those transactions. I take that again. When you say the regulatory framework, we are talking about the laws, the principles, the rules, and regulations that govern how business transactions are recorded and how these records translate into the preparation of the financial statement. That is what we term as the regulatory framework. So if it's the management that is going to prepare the financial statement, they prepare it in consonance with the laws, with the principles, with rules and regulations that govern how transactions should be recorded in the books of accounts and how these transactions which has been recorded are used to prepare the financial statement. That is the meaning of the regulatory framework. What about the conceptual framework? I'll come back to the regulatory. I just want to give you the platform for understanding the three concepts that I alluded to earlier: the regulatory, conceptual, and the ethical. I've dealt with the regulatory framework. Now, when you talk about the conceptual framework, now they basically deals with concepts. That is the standards, how accountants will apply the concepts that underlie each standard and use them to prepare the financial statement. And that will also inure to the benefit of the users of that financial statement so that they can understand it more. So the conceptual framework spells out the concepts that underlie the preparation and presentation of financial statement for external users. So the conceptual framework spells out the concepts that underlie the preparation and presentation of financial statements for external users. When I say external users, those people outside the organization that use their financial statement to make their own decisions, So apart from the regulatory framework and the conceptual framework, the accountant is also expected to comply with ethical and other professional ethics of the accountancy profession. So apart from the laws, apart from the concepts, the accountant is also expected to comply with what we normally call the ethical principles of a professional accountant. And very soon, we shall look at these ethical principles. Basically, we have 5 ethical principles. So we shall look at these ethical principles. So I have now explained the 3 major concepts that underline our study this morning. I have talked about the regulatory framework. I have talked about the conceptual framework, and I have talked about the ethical framework. Now, the next question is, why do we need to regulate how financial statements are prepared? Why do we need at all to regulate how financial statements are prepared? So the need for regulation. Why is it at all that we should regulate how financial statements are prepared? And the simple answer is that earlier I mentioned that the financial statements are prepared for users. Very soon, we will know who are the users of the financial statement. So these financial statements are prepared for users of those statements. And when we regulate how these financial statements are prepared, then it is going to ensure that those users of the financial statement receive minimum amount of information that is relevant and reliable to help them to make their informed or economic decisions. So the need for regulation is that it will enable the preparers, of the financial statement to at least have a threshold of information that they have to give the users of these financial statements, which will be relevant for their decision making, which will be reliable for their decision making. If not, then the preparers of the financial statement will just provide any information at all, which may not be relevant and cannot be relied upon by the users of that financial statement. So the need why we regulate how financial statements are prepared is to ensure users receive minimum amount of information that is relevant and reliable for economic decision making. I hope that is clear. Is that clear? Are you
Yes,
there?
Doc.
Very
Yes,
good.
Doc.
Very good. Very good.
Yes, please.
All right. Now, I have given you, by way of introduction, what regulatory framework is, which I told you earlier that it is the laws, the principles, the concepts, the conventions that guide the accountant, or that the accountant will have to follow when preparing the financial statement. So more technically, the regulatory framework is a general term that describes the laws, body of rules, principles, standards, concepts, and conventions that govern financial reporting of entities' business activities. Where will they get these laws from? Where will they get these rules from? Where will they get these principles from? Where will they get these standards from? Where will they get these concepts and conventions from? They will get some from the generally accepted accounting principles. The gap means generally accepted accounting principles. Some national, some local. For instance, in Ghana here, when they want to prepare the financial statement, they have to comply with the requirements of the Companies Act, the Companies Act of 2019, Act 992. So they have to comply with the Companies Act of 2019, Act 992. Then there are some companies that also operate on the stock exchange. Then they have to also abide by the stock exchange regulations. And then there are regional accounting bodies which have also made some rules and principles. And so far as you belong to that regional accounting body, you have to follow those rules. And typical among the rules is the application of the standards which has been set by the regional accounting bodies, like the International Accounting Standard Board. They have set out the International Accounting Standards and the International Financial Reporting Standards. So these standards serves as a regulatory regime for accountants when also preparing the financial statements. Now you see that I have put in red ink that the standards alone are not enough. You need other regulatory regime to help you prepare a reliable and relevant financial statement. So some of them you can use the local generally accepted accounting principle, we call the GAP, generally accepted accounting practice, or generally accepted accounting principle. Now, a regulatory framework, as I have told you earlier, the regulatory framework is required for two main reasons. So when I ask you in a quiz or end of semester to produce two main reasons why there is the need for a regulatory framework, you should be able to tell me that this regulatory framework acts as a central source of reference, serves as a central source of reference of generally accepted accounting practice. or principles. And then these regulatory framework will also usher in an enforcement regime, because it is one thing setting the rule and another thing enforcing it. So one leg is to act as a central source of reference, and the other leg is to enforce that the generally accepted accounting practice have been complied with. And if they do, then it will ensure that there is consistency in the preparation of the financial statement. It will bring about consistency in the preparation of the financial statement. You will agree with me that when there are no regulations, that is the laws, the rules, the principles, and the concept, if they are not there, it means that each entity will use their own means of preparing the financial statement. And when they do that, they will not be consistent. And it will not foster comparison of one company against the other. Because before you do comparison, the two companies that you are comparing might have adopted the same principle in the preparation of their financial statement. So if these rules are not there and they prepare it based on their own rules, then it will not bring about consistency in the preparation of the financial statement. And it will not also bring about what we normally say harmonization. It will not bring about comparison. It will not harmonize the way financial statements are prepared. When I say it will not bring about harmonization, I am talking about it will not enable us to have a common source of reference for preparing the financial statement. And where we don't have a common source of reference for preparing the financial statement, consistency will be absent. And where consistency is absent, it will not foster comparison. And that will not help us to harmonize the way financial statements are prepared. So it is very, very important. Or even in the next slide, it's talking about harmonization. Harmonization is where there's an agreement on how we use accounting standards and practices among countries. How accounting standards and practices are used among countries. Remember, we used to say that the world has become a global village. So if the world has become a global village, then we trust on interdependence. One country depends on the other. People can move across countries, and investments can also move across countries. So those people who are going to invest should be assured that the standard in which probably their financial statements are prepared in their home country will be the same when they send their money outside their country to neighboring countries. So harmonization is the process of increasing the level of agreement in accounting standards and practices among countries. So it treats the whole world as a single entity, the whole globe as a single entity. And if the whole globe is seen as a single entity, then we have globalization of trade and capital markets. When I say globalization of trade, it means that you can go anywhere and trade without necessarily even traveling. You can sit in your home country and trade outside. You can buy, you can sell, you can invest. But before you can do that, then the system of preparing a financial statement has been harmonized so that you understand how those countries prepare their financial statement, you understand their tax laws, you understand various things that normally is taken into consideration by one country in respect to the other. So some of the advantages of harmonization is that multinationals, when I say multinationals, that is big companies from different countries can go to other countries to transact business. So multinationals can go outside their country and invest. Other investors can also send their money. If you are in US, you can bring your money to invest in Ghana. Why? Because you think that the standard for preparation and the management of the financial statement are the same wherever that you go. And that tax authorities understand how these financial statements are prepared. And these international accounting firms, whether it's an auditing firm or what, they all have a clear knowledge of how these rules, how these regulations are applied, and that they can move from one country to the other to transact their business. That is why even in auditing, you see that when you pick the big four audit firms in Ghana, the big four audit firms. Let me ask you. So what are the big four audit firms as a business student? Let's discuss that one. What are the big four audit firms in Ghana? Adela, have you come? Adela, have you come? He's still not on board, or he's not doing accounting. Hello?
He's doing accounting.
And he's not.
We don't know because he's always regular.
Hey.
Maybe network, he's having network issues.
Okay. So, is that Rita?
Yes, please.
So, give me one of the big four audit firms.
Big ball.
Big four audit firms in Ghana. Four audit firms.
The Internal Revenue Authority.
That is a good attempt. Abubakari, give me one. Abubakar, Anthony, Daniel, Minta, are you there? Give me one of the big audit firms in Ghana.
I think there's one. I don't get the whole. I mean, Deloitte and something. I don't get the whole.
Deloitte and what? It's Deloitte. Deloitte.
Yes, yes.
It was first Deloitte and Touche, but it's Deloitte.
Yes, yeah.
Deloitte. Senna, give me one. Senna, are you there?
Yes, please.
Yes, give me one big audit firm. There are four big audit firms in Ghana, so give me one. Daniel, you have not responded though. Or you are the one who responded, Daniel.
Yes, sir.
Okay. Abubakari, you have not responded. Danny, give me one. Godfrey, are you there? Give me one. Rimpoma, are you there?
Sir,
No, you are there. So give me one.
yes. A Global Consult Audit Firm.
Global Consult Audit Firm. Prince Bachi, I'm still
We
waiting.
also have KPMG audit firm.
KPMG.
MJ.
So, what is the full meaning of KPMG?
Please, Doc, I don't know the full meaning, but I know that they offer tax and audit and advisory services.
Yes. So, you don't know their full name.
Yes, please.
KPMG. So, someone mentioned Deloitte. Someone has also mentioned KPMG. What again? These are the two that we have mentioned. What again?
I also mentioned the Global Consults Audit Firm.
Yes, the Global Consult Audit Firm is one of the audit firms but they are not among the big four. Are you following? They are not among the big four.
Yes, sir. Okay.
Okay. So the big four, which we say the big four, means they are the largest accounting and audit firms, even in the world. We have Deloitte. At first, it was Deloitte and Touche. Now it is Deloitte. Deloitte. We have Price Waterhouse Coopers. That is what we call the PwC. Price Waterhouse Coopers. We have Ernst and Young. Ernst and Young. And then we have the KPMG. KPMG. Clivert Pitch Maverick Gadler. That's the full meaning of KPMG. So it's a German sort of a company. So these are the big four audit firms. Don't forget as an accounting student. We have the Deloitte. We have Price Waterhouse Coopers at the PwC. We have Ernst and Young, which is EY. Then we have the KPMG. So because financial statements preparation has been harmonized, these international accounting firms can go to any country at all to go and audit their financial statements. Is there any disadvantages of harmonization? Disadvantages of harmonization. Let's discuss that one. Is there any disadvantages? Yes. Disadvantages of harmonization. It is not me alone that should be talking. You should be helping me. We have known what is meant by harmonization. Now, I've talked about advantages. It helps multinationals to move from one country to another to operate businesses. It helps investors go around the globe, tax authorities to have standardized means of understanding the financial statement prepared. Then international accounting firms can move across boundaries to go and audit financial statements. Then I ask you, is there any disadvantages of harmonization? If
Yes, please.
so what are they?
Doc, I think loss of flexibility.
Loss
Because
of flexibility.
flexibility. Because since there is a laid down principle that you are supposed to follow, you cannot do your own thing as a business firm.
Okay. What again? That's good. What again?
Please, Doc.
Yes.
I think there also it is costly to comply with the standards. The cost
That is
involved.
also right. Yeah, it's very costly. What again? Yes. The rest, talk, please. We are all in the class together. It's a discussion class. So talk. The rest. Yes. Frimpoma, give me one. You will suffer from me because you are my name. So if I forget any name at all, not your name. So Frimpoma, give me one.
Sir, please pass it on. I'll come. I'll give it.
Okay, I should pass it on. So
Yes.
mention the person that I should pass it on to.
Say, I think one is inappropriate standards because some of the standards are inappropriate.
Some of them.
Yeah.
Some of them are inappropriate.
Yes, sir.
So explain why you think they are inappropriate.
Okay. So, in my point of view, a single standard may be willing to take over all the responsibilities and be the one to be function whilst neglecting the other to be malfunctions.
Okay. Any other from I can come back. Yes. Come on.
Dog,
Yes.
please, can I also say resistance from employees?
Resistance from
Employees, the workers. That sometimes they have been using the system for so long, and when there's and now a lay down principles laws that they need us to follow, they may resist to change their familiar system.
so you can say normally there are transition problems. Transition. I get it. Transition problem. But when you are shifting from one system to another, no
Exactly.
transition problem. Okay.
Thank you.
Any other disadvantage?
Please, can we also say that it will lead to loss of cultural identity?
Yes, you can say loss of not cultural identity, but loss of national or local relevance. No, you will not use your own national standard. Always people or the association will bring their standards. I get it. Then you have to adopt those standards. So loss of national or local relevance. I hope you understand what I'm saying. Hello, are you there? The one who gave the contribution.
Yes, I'm here.
Yes. Okay, very good. Any other? So it will reduce innovation. It would reduce innovation because always people will think for you and then you apply. So it reduces innovation. And then dominance of developed countries. Their interest is always dominant. Then at times you have what we call enforcement challenges. Enforcement challenge. So these are all some of the disadvantages of harmonization. I hope you have written them down because it is not, I didn't put them on the slide. I want you to learn them. So I hope you have written them down. Or you didn't?
I've written some.
Some. Okay. Let's continue. Then I have looked at the regulatory framework. I'm now looking at the conceptual framework. What is the conceptual framework? Now, the conceptual framework was put in place by the International Accounting Standards Board. The International Accounting Standards Board. They promulgated or made the conceptual framework. And the current conceptual framework, I think, is the 2018 version that we are still using. The 2018 version of the conceptual framework. So what do we mean by the conceptual framework? They are what we call generally accepted accounting principles. So all the generally accepted accounting principles that you know came from the conceptual framework. So the conceptual framework is a statement of generally accepted theoretical principles which form a frame of reference for financial reporting. And when you go through the conceptual framework, it is made up of about 6 parts. The conceptual framework is divided into 6 parts, which we are going to look at. Some of them deals with the uses of the financial information. See, when we started, I told you when these financial statements are prepared, they prepared in favor of uses. So when you go to the conceptual framework, it spells out the uses of these financial information and the information that they need from the financial statements that management has prepared. It doesn't mean that all users require the same information. No. It depends on a particular user and the particular information needs of that user. So if you look on the current slide, you will see that I'll put some of the users there. Investors are users. Lenders and creditors, they are users of the financial information. Customers, they are users. Bankers, they are users. Government, they are users. Trade unions, they are users. So many of them. The tax authorities. I've just listed 3 of them. As we go on, you will get to know the users and the information that they need from the preparation of the financial statements, from the preparation of the financial statements. What is the purpose of the conceptual framework? Why the conceptual framework at all? So you see the purpose of the conceptual framework. Now, basically, I have about 6, 7, or 8 purposes of the conceptual framework. So many of them. To assist the International Accounting Standard Board to develop future accounting standards, to assist the International Accounting Standard Board by providing a basis for reducing the number of alternative accounting treatments, to assist the national standard setting bodies in developing national standards, so many of them, to assist accountants to apply relevant accounting standards, to assist auditors in forming an opinion whether the financial statement management has prepared conform with the relevant accounting standards. It also assists the users of the financial statements in interoperating the information contained in the financial statement for them to understand and use it to make their informed or economic decisions. So many of them, the purpose of the conceptual framework. You have to note that you'll be called upon one day to account for it. You'll be called upon one day to account for it. The purpose of the conceptual framework. I told you earlier that the conceptual framework has 6 major parts, and you have to note it very well. When you pick the conceptual framework, it has been divided into 6 major parts. The first one is the objective of financial statement. Why do we prepare financial statement? That's the objective of financial statement. That's number 1. Number 2 talks about the user groups, that those people who use the financial statement. I just mentioned some of them to you. When you go to part 3 of the conceptual framework, it talks about the assumptions underlying how financial statements are prepared. The assumptions that underline how financial statements are prepared. Part 4 talks about the qualitative characteristics of financial statements. The qualitative characteristics of financial statements. Part 5 talks about the elements of financial statements and how these elements of the financial statement are recognized and measured. And lastly, it talks about the concept of capital and capital maintenance. The concept of capital and capital maintenance. So we will take each of them and know what goes into all the 6 parts. What goes into all the 6 parts. It is very, very important. So the first part is the objective. So here I've given you some advantages and I think disadvantages. Yes, you can learn them on your own. Advantages of the conceptual framework, and then the disadvantages of the conceptual framework. So these are all things that. And I mentioned earlier that what we are using now is the 2018 version of the conceptual framework. I think I mentioned it earlier. So that one is also there. These are things that I mentioned earlier. The objective, qualitative analysis, the elements, recognition, presentation, disclosure. These are the 6 things that I mentioned earlier. So we are going to take them one after another. So the objective of financial statements. The objective. Why do we prepare financial statements? The objective of general purpose financial reporting. The objectives of preparing financial statements is to enable users use the information from the system to help them make an informed or economic decision. To make an informed or economic decision. So the objective of preparing financial statements, is to enable users use the information from the system to help them make an informed or economic decision. So if you read further, it will tell you that the objectives of preparing financial statements is to provide users with information for their economic decisions. Then it will also show the financial performance. It will show the financial performance of the entity. It will also show the financial position of the entity. Then it will also show how the entity has complied with legal and other regulatory requirements, other legal and regulatory requirements. They will be able to do that where they know the economic resources of the entity. Now, when I say the economic resources of the entity, I am talking about the assets. Know the claims against the entity. And the claims against the entity are the liabilities. And then the changes in these assets and liabilities within the year. And if the preparers of the financial statement is able to provide such information, then it will have the users to use that information to make their decisions. And what decisions can they make? Decisions to buy more shares, decisions to hold the shares that they have in the company, or decisions to sell what they have in the company. Decisions about whether management is looking after their money well or not, and whether management is being accountable with the resources that has been entrusted into their care. Decisions about the entity's ability to pay employees. Decisions about the security of amount that they have lent to the entity, that when the time matures, the entity will be capable of paying back whatever amount that was lent to them. So the objective of preparing financial information is to show users how the money that has been entrusted into the care of management has been used in managing the affairs of the entity. The next thing that we shall look at, after all, the steward. Steward means taking care of whatever has been entrusted into your care. So that's one. Then we come to the assumption. Part 2 of the conceptual framework talks about the underlying assumptions when preparing financial statements. The underlying assumptions when preparing financial statements. And there are two basic assumptions. There are two basic assumptions when preparing financial statements. One, we have the accrual basis assumption, and then we have the going concern basis assumption. We have the accrual basis assumption and the going concern basis assumption. As you might be aware, when have you done introduction to accounting? You have done introduction to accounting.
Yes, Doc.
As the foundations, very good. So you know what is an accrual concept. True of us? Now you won't talk. You know accrual concept. Yes or no? I won't ask question. I'm just asking.
Yes, yes, please.
Aha,
Yeah.
this is one thing. Something that you have learned and written exams on it. You fear that I'll ask you question. Now, these two assumptions, the accrual basis and the going concern basis, are the two major assumptions that accountants make when preparing financial statements. What is the accrual? Accrual simply implies that when the business make transactions or enter into transactions, whether they have paid for it or not, So far as exchange has taken place, they have to take it into consideration. It's because of these accrual basis. That is why we have owings and prepayments. So whether the person, the transaction you have entered to, so far as there has been consideration, whether you have paid for it or not, you are obliged as a liability. So you have to take it into consideration. That's the accrual basis. Then we have to also have what is called the going concern. Now, the going concern also talks about the entity being capable of operating for the foreseeable future. So when management prepare financial statements, they have it at the back of their mind that the business is going to exist into the foreseeable future. That is why when they prepare the accounts, they write balance carried down and balance brought down. If they think that the business is going to collapse tomorrow, what are they bringing down on carrying down? There will be nothing there. If you know you will die tomorrow and you have money in your pocket, what will happen? You will spend all. So you don't carry anything down. But because they have this assumption that the business is going to exist in the foreseeable future, when they are preparing the accounts, they should use the historical cost of the transaction rather than the market value. The moment you use the market value, it means you are selling the business. But they should use the historical cost. That is the actual cost that they bought the items. Because they have at the back of their mind that the business is going to exist into the foreseeable future. So these are the two underlying assumptions: the going concern and the accrual basis. The going concern and the accrual basis. These are the two. Then another part of the conceptual framework talks about the qualitative characteristics of accounting information. The qualitative characteristics of accounting information. And thus, qualitative characteristics of accounting information has been divided into two categories. We have the fundamental qualitative characteristics of accounting information. Then we have the enhancing qualitative characteristics of accounting information. So we have the fundamentals, qualitative characteristics of accounting information. Then we have the enhancing qualitative characteristics. Enhancing means complementing the fundamental. So the fundamental become the basic qualitative characteristics of accounting information. Then the enhancing is complementing or aiding the fundamental for them to do their work. So the fundamental qualitative characteristics of accounting information are two. We have two of them. One is relevant or relevance, and faithful representation. Relevance and faithful representation. These are the two fundamental qualities of accounting information: relevance and faithful representation. So if you look at the slides before you, you see the fundamental qualitative characteristics. They are the first two. The materiality and prudence emanates from relevance and faithful representation. So they are not separate qualitative characteristics. The materiality and prudence are not separate qualitative characteristics. They emanate from relevance and faithful representation. So when we say information is relevant, then that information is capable of making a difference in decision that is made by the users. That information should enable users to be able to predict what is going to happen in the future and be able to get a feedback from the system. So information is relevant when it possesses a predictive value and a feedback value. The feedback value is the confirmatory value. So if we say the information is relevant, then it must possess a predictive value and a feedback value, or a confirmatory value. Then another fundamental qualitative characteristic is faithful representation. It means the financial statement you have prepared is not biased, it's complete. The preparer of the financial statement is neutral, and the financial statement has been prepared free from error or any material misstatement. Then we say that there has been faithful representation of the financial statement. Since you did the concepts, you did, okay, let me ask you. You have done the concept. So what's the prudence concept? You can't tell me you didn't do it in the foundation. You did accounting concept. So what's the prudence concept? If you fail to give me what is meant by prudence concept, yeah.
Doc, I think that's the concept that you don't need to anticipate profit in future,
But do what?
but for your losses, then you should recognize it.
So what's another name for prudence concept?
Let me try conservatism.
Conservatism. The concept of conservatism. That is the prudence concept, which talks about the accountant should not anticipate profit, but to take into consideration all foreseeable losses when preparing the financial statement. So the exercise of caution when making judgments under conditions of uncertainty. Under conditions of uncertainty. All right. So let's look at the enhancing. The enhancing. The enhancing, we have comparability, verifiability, timeliness, understandability. These are all qualitative characteristics that complements relevance and faithful representation, so that the financial statements which have been prepared, users will get the needed information to help them make an informed or economic decision. Make an informed or economic decision. So when you say comparability, information is more useful if it can be compared with similar information about other entities, about other periods. So comparability brings in consistency, because where there's no consistency, there'll be no comparability. Then verifiable. The information that you have used in the preparation of the financial statement to be those that you can verify from records. Then the information is provided when it is needed. That is timeliness. And then the accountant must provide additional notes that must accompany the financial statement to aid users' understanding of the financial statement. So these are the enhancing qualitative characteristics of accounting information. Then we come to the elements of the financial statement. The elements of the financial statement. So I'll have a 10-minute break, then I'll come back. Are you okay with that?
Yes, please.
Yes.
Yes,
I'll-
please.
yes. 10 minutes break, water break. Then I'll come back. We'll continue from the elements of financial statement. Thank you. All right. I'm back. Are you there?
Yes, please.
Very good.
Yes, please.
Very good. Thank you very much. So we are looking at the element of financial statement. Now, that is another component of the conceptual framework. Another component of the conceptual framework, which looks at how these elements of financial statements are recognized and measured. And basically, we have 5 elements of the financial statement. We have assets, we have liability, we have equity, we have income, and we have expense. So there are 5 elements of the financial statement. So technically, when you say an asset, what does it mean? Technically. So you could see that all the definitions that I have given have made reference to the conceptual framework. So when you say an asset is a present economic resource that the entity controls as a result of past events and from which future economic benefits are expected to flow to the entity. So any resource that is flowing to the entity becomes their asset. But where the economic resource is being transferred from the entity to any other entity or person, then it becomes their liability. Then the residual interest of the assets and liabilities is what we term as the equity. So in your foundations of accounting, foundation of accounting, you saw that when you pick the accounting equation, you have assets equals equity plus liability. What that tells you is that equity is the difference between your assets and your liability. That is why they use the term residual interest. Whatever is left, residual interest in the assets of an entity after deducting all its liabilities. That is what is termed as an equity. So if in examination I ask you to write short notes on the following column: 1, assets. You have to know that assets is the present economic resource that an entity controls as a result of past events and from which future economic benefits are expected to go to the entity. And the liability is the present obligation of the entity to transfer an economic resource as a result of past events. So past events simply means that today, if I buy a bottle of water from you and I don't pay, it means that I have an obligation to pay you in the future. So if I promise to pay on Tuesday and I give you the money on Tuesday, something has happened in the past before I am paying you on Tuesday. So my obligation to pay you on Tuesday is as a result of something happened in the past. That is called past event. So a present obligation of the entity to transfer an economic resource as a result of past event. As a result of past event. That's an asset, liability, and equity. What about expenses and income? People at times confuse income and revenue. Income and revenue are not the same. Income and revenue are not the same. Income goes beyond revenue. When we say revenue, revenue is the receipts from your normal operating activities. The key word is from your normal operating activities. So all monies that you receive from normal operating activities is your revenue. But when I add other sources of revenue, then it means that the money I have now is not as a result of the normal operating activity, but other income has been added to it. That's why we call it income. So income is revenue plus gains, losses. And that will give you your income. So income and revenue are not the same. Technically, when we say income, it means your asset is increasing or your liability is decreasing. So income is increases in assets or decreases in liabilities. That is the key word. Either your asset is increasing, or the more your asset increase, then it means you have more income. And the more your liability is decreasing, it means more money is in your pocket. If I owe you 1,000 Ghana cedis, and you say that, oh, I've dashed you 500, my income is increasing because I will not part with the 500 that you have dashed me. So income is increases in asset or result. You can even see results in increases in assets or decreases in liabilities or decreases in liabilities, other than those relating to contributions from holders of equity claims. Then we go to expenses, which we also define it as a result of decreases in your economic benefit. Decreases in your economic benefits. So where your economic benefit is decreasing, it's an expense because more money is going away. Or where your liability is increasing, it is an expense. So expense is where your economic benefit decreases or your liability increases. Where your economic benefit decreases or your liability increases. Okay. How do we recognize and measure these elements? I'm talking about the assets, liabilities, income, expenses. How do we measure and recognize them on the financial statement? Now, note this one. This one is not on the slide. Note it very well. An asset is recognized on the financial statement when it is probable that future economic benefits, where it is probable that future economic benefits that is inherent in that asset, the future economic benefit that is inherent in that asset will flow to the entity, and that's the cost can be measured reliably, and that's the cost can be measured reliably. So I'm giving you two criteria. I said an asset is recognized or an item of expenditure or an asset, whichever it may be, can only be recognized on the financial statement where the benefit will flow to the entity. Then the cost is also known to the entity. Because if you don't know the cost, how much are you going to record it on the face of the account? So taking it onto the face of the account is what we term as recognition. So recognition is the process of recording or showing an item in the financial statement. That one is known as recognition. But what is the measurement? Measurement is what amount are we showing the item on the financial statement. So recognition is sending the item to the financial statement. Measurement is how much are you recording the value or the figure for the item that you have sent to the financial statement. And we have so many measurement criteria for recognizing items on the financial statement. We have so many measurement criteria that we can use depending on the type of item that we want to recognize on the financial statement. So this one I've talked about it. This one, let me see. Very good. So measurement is the process of determining the monetary amount at which the elements of the financial statement are to be recognized. That's why I said, at what amount are you going to record it? And we have so many of them, methods that you can employ. You can use the historical cost basis. You can use the current cost basis. You can use the realizable value or the deprivable value basis. And you can also use the present value basis. So let's talk about each of them. Now, when you say you are using the historical cost, historical means history. That is the cost, the original cost that you bought the item is called the historical cost. So if you want to measure an item or the elements on the financial statement, are you going to use the historical cost or what? And I've told you that the measurement basis that you will employ depends on the item that you want to measure on the financial statement. You can also use current cost, which you can call the replacement cost. I mean, if you want to replace the item today, how much does it cost? That's the current cost of the item. You can also use that. You can also use realizable value. Realizable value means when you dispose of the assets and you deduct your expenses for disposing of the assets, whatever that you get is what you call realizable value. Are you going to use that? Or you are going to use the present value? The present value. When I say present value, not that today's value, no. The present value here means that you will have a value, you discount it in today's terms. That's called present value. So you only get present value with the help of a discount factor. You do it maybe next week when we are dealing with, or the next meeting when we are dealing with IFRS 13, fair value measurement. Then you will know about present values. Very important. Okay. So we are also done with the conceptual framework. So you see, we have done regulatory framework. Then we are also done with the conceptual framework. Now, the last bit talks about the ethical framework. The ethical framework. That is the third portion, the ethics. When I say you are being ethical, it means that you are doing things that, in the eyes of reasonable persons, the actual thing that you ought to do. So, as an accountant, when preparing financial statements, there are some ethics that you should adhere to. And these are what we normally call ethical principles, which was brought into being by the IESB, International Ethics Standards Board. International Ethics Standard Board. And we have 5 of such ethical principles. We have 5 of such ethical principles. We have the principle of integrity. We have the principle of objectivity. We have the principle of professional competence and due care. We have the principles of confidentiality. Then the principles of professional behavior. Please note them very, very, very well. The ethical principles, they are 5. Integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. Let's take them one after the other so that I can explain them to you. Let's take the first one, the principle of integrity. It means that as an accountant, when preparing the financial statement, you should be as honest as possible and you should be straightforward. That is the principle of integrity. You should include all those things that you need to include, and then also not include all those things that you shouldn't have included. That is the principle of integrity. Then we have the principle of objectivity. When you say you are objective, the accountant is not being biased. The accountant is not having what you call conflict of interest. And the accountant has not been influenced by any higher authority. That's what we call undue influence. That is what is meant by objectivity. Being faithful, not biased, not having conflict of interest, and not unduly influenced. Now, I want to say professional competence and due care. It means that you should have what it takes to be an accountant. You should have the needed qualification that qualifies you to be an accountant. So you should be competent enough. Professional competence confers on you by the skills that you possess. And in the preparation of the financial statement, the accountants need to exercise due care. Due care means that if they use information that misleads the users to pay reliance on that information to make decisions, and later on it is detected that such information is false, the accountant can be held civil and criminal liability. So the accountant must be professionally qualified and must exercise care when performing his duties, so that his actions or inactions will not injure third parties. When I say third parties, those whose interest or benefits the financial statement has been prepared. Then, as an accountant, you should be confidential. It is not everything that you see by virtue of your position in the entity. You will come across so many things. It is not everything that you see that you have to disclose to the general public. So the principle of confidentiality will enjoin the accountant not to disclose information that he does not have authority to disclose. He cannot disclose information that he has no authority for whatsoever to disclose. Then the last one talks about professional behavior. It means that as an accountant, when performing your duties, you should do so based on the association that you belong. Your behavior to be someone who is seen as a professional, so that if you go contrary to your professional ethics, you will be sanctioned by your professional body. They can suspend your certificate or membership. They can dismiss you from being a member of that body, or they can reprimand you in any form or shape in that association. So you see that even though there are regulatory and conceptual issues that the accountant will have to comply with, there are equally important ethical issues that the accountant should also comply with. Very, very important. Now, let me take you through. Now, I'm going through the standard. Let me take you through the International Accounting Standard number 1. The IAS 1 talks about how financial statements are to be prepared. So the preparation of financial statements or the presentation of financial statements. The law or the standard that governs how you present financial statements is found in the International Accounting Standard number 1, IAS number 1. So if you look at the objective of IAS 1, it will give you what is required to present financial statements, what the general framework that you can use to present financial statements is what is contained in IAS 1. It will give you the guidelines and the layout of the various financial statements that you should prepare. It's very, very important. So let's look at the layout or the structure. This one, you can learn it yourself, it's not anything. Yes. So this is what I was talking about, the general structure of financial statements. And basically, we have 5 financial statements. 5. Some books says 5 major financial reports. 5 major financial reports. Can also talk about financial statements, and there are 5. 1, you have statement of financial position. The one previously called balance sheet. Now, we don't say balance sheet. It's a statement of financial position. Number 2, we have income statement or statement of profit or loss and other comprehensive income. Or you can simply say income statement or statement of comprehensive income. At first, you will call this one trading profit and loss account. Now we don't call that one trading profit and loss account again. You either say income statement or statement of profit or loss and other comprehensive income. Number 3, we have statement of changes in equity, which is the same, statement of changes in equity. We also have statement of cash flows. We will do that one. I think that one is accounting too. Yeah, financial reporting too. We do statement of cash flows. Yes. And then number 5, we have additional notes. So the 5 major reports are: 1, statement of financial position, statement of changes in equity, statement of profit or loss and other comprehensive income, statement of cash flows, and additional notes. Additional notes attached to the account. There are 5. These are the 5 major financial reports. Let's look at each of them. When you are preparing any financial statement, and it's very, very important, when you are preparing any financial statement, the following must be borne in mind. The following must be borne in mind. 1, you have to write the name of the reporting entity. So at times they give you ABC Company Limited. You have to write the ABC Company Limited on top of the financial statement that you are preparing. If it is Evans and Co. financial statement, you just write Evans and Co. at the top. So the name of the reporting entity is very, very important. You have to show it. And then the type of financial statement that you are preparing. If you are preparing for a single company or a group of companies, normally when you go to consolidation, you can prepare accounts for 3 or more companies. So we call that one consolidation or consolidated financial statement. But if it's for a single, just write the name of the entity on top, then you write the name of the financial statement that you are preparing. It's very, very important. Then the period that the financial statement is covering, for the period ended, so you write all. Very, very important. And then the presentation currency. So if it's in city sign, always you have to put the city sign there. If it's in pounds, you write pounds. If in dollars, you write dollars. It is very, very important. And then the level of rounding up. At times, they can tell you the accounts have been prepared based on maybe 3 decimal places or 2 significant figures. So you have to know the difference between decimal places and significant figures. That's why I'll ask you the next time we meet. Difference between decimal points and significant points. I'll ask you the next time that we meet. You should be able to tell me. Then let's take each of the financial statements. For instance, when we take the statement of financial position, which first we call the balance sheet. When you go there, principally, you see three major items. Principally, you see three major items in the statement of financial position. You see assets, you see liabilities, you see equity. So you have to show the assets separate, you show your liability separate, and you show your equity also separate. Now, when you are presenting the assets, you can present it in the order of tangibility, how tangible the asset is. So you can choose to write the non-current assets first. Previously, you call it fixed assets. Now you don't call it fixed assets. There's nothing like fixed assets. You say non-current assets. So you write the non-current assets, then you come and write the current assets. When you go to the liability, you write the non-current liability, then you write the current liability. So this is the format, because I've told you the IS1 is giving you the format for the preparation, of the financial statements. So it is not today that I'm going to classify current assets and current non-current assets. You know them from your foundations. So these are not anything. Then when it comes to the income statement or the statement of comprehensive income, which will show you your profit that you have made for the period. Under this statement, you need your revenue, you need expenses to help you measure profit. It is also very, very important. Then when you go to statement of changes in equity, anything that affects the shareholders' interest in the business, anything that affects the shareholders' interests in the business are reported on the statement of changes in equity. I'm talking about anything that will affect the stated capital or the share capital, anything that will affect their reserves, anything that will affect their retained earnings. All of them will be reported on the statement of changes in equity. Then I told you we have notes to the financial statement. And the notes to the financial statement can be made up of some of these. We can say that these are the information that always you will have. But the notes to the financial statement are those information that is going to help the user understand the financial statement that you are prepared proper. That's what it calls notes to the financial statement. They are information that the preparers of the financial statement will provide that is going to aid the users of those financial statements to be able to understand the financial statement that has been prepared by the accountant. Then this is just example of how the statement of financial position will look like. I mean, when you are trying to put it together, you have your non-current assets, you list them. You have your current assets, you list them. You have your equity side, you list them. You have your non-current liabilities, you list them. Then you have your current liabilities. So this is the format. Then when you go to the statement of comprehensive income or the income statement. This is how it goes about. You state your revenue. First, you say sales. Now you say revenue. Then you get your cost of sales. You will not find the cost of sales on the face of the financial statement. No. You will prepare the cost of sales by way of footnotes and get one figure as cost of sales. Then you bring it to the face of the account. So revenue minus cost of sales will give you gross profit. Then all your expenses are also grouped. You have distribution expenses, you have administration expenses, you have what do you call it? So distribution, administration, production, all expenses are also grouped according to their function. So then you list all other incomes and expenses. It is very, very important. Then when you go to the statement of changes in equity, the statement of changes in equity, let me see if I can make it here proper for you. Just a minute. I want to see. Oh, okay. Now you see the SC. This SC is stated capital or share capital. The SD is share dues, revenue reserve, retained earnings. You bring their opening balance. If there's any adjustment for the year, if there's any dividend that you pay, if you have issued any shares or any shares, or you have transferred anything, which affects any of these items on top here. If it affects any of these items, you record them. And then in the end, you will get one figure that will be shown. You get one figure that will be shown as your equity item on the financial position. When we start the actual working, you will see what I am trying to say. Okay. This is the last part of our lecture. Yeah. So let's see. Yes, any question up to this point? Any question up to this point?
Yes, please, Doc.
Yeah.
Please, may I know whether these accounting standards set up by the IASB, IFRS are compulsory or they are just directives or guidelines?
No, Ghana has adopted. Ghana has adopted and signed on to the IFRS, IAS. So it is compulsory for us to apply them. You know, the regulatory body for accountants in Ghana is ICA, Institute of Chartered Accountants, and they have adopted the International Accounting Standards and the International Financial Reporting Standards. So under no circumstance will you prepare financial statement without recourse to the International Accounting Standards and the International Financial Reporting Standards. So it is not optional, it is compulsory. Even those in the public sector, now we have also adopted IPSAS, International Public Sector Accounting Standards. So there are accounting standards for those in the public sector, as we also have the IAS for those in the private sector. Are you okay? Hello, are you okay? Hello?
Yes, please. Thank
Okay.
you. Yes, please.
Okay.
Please, is it because it has it become mandatory because we are signatory to that?
Yeah, it is mandatory. It is mandatory now. Long time ago, it is mandatory. So all accounts that you prepare should be according to the standards. Everything that you prepare should be according to the standards. That's why we learn the standards, so that you know how to apply them. Are you okay?
Yes, please, Doctor. Thank you.
Very good. Any other question? Any other question? Okay. Now, the International Accounting Standard Board, they are responsible for setting out international accounting standards. The International Accounting Standards Board. If you look at the organogram, I mean the charts, on top of the IASB is International Federation of Accountants. That is the international body for all accountants. It is called the International Federation of Accountants. Beneath the International Federation of Accountants, then we have the International Accounting Standard Board. And the work of the International Accounting Standard Board is to set standards. So if you look at the objective of the International Accounting Standard Board, is to develop a single set of high quality, understandable, and enforceable. So you see, enforceable. If you become a member of the International Federation of Accountants, there's no way you will not apply the accounting standard. It becomes enforceable. So the objective of the International Accounting Standard Board is to develop a single set of high quality, understandable, and enforceable global accounting standard. And to promote the use and rigorous application of those standards, to promote the use and rigorous application of those standards, and to work actively with national standard setters to bring about convergence. So for instance, if Ghana have their own standards, like the GAP, and we also have the International Accounting Standards, this International Accounting Standard Board will work hand in hand with our local standard setters to bring about what we call convergence. Convergence means that where they have differences in the treatment of like items, they look at what this standard says and what that standard says. Then they iron out the differences and have one unified treatment for that item. That is why they said to work actively with national standard setters to bring about convergence of national accounting standards and IFRS to high quality solutions. How do they set the standard? How do they set the standard? How do they set the standard? There are 6 steps that must be followed to set up the standard. And when we say they are steps, it means from 1 before you can go to 2. So when I ask you in the exams to state the standard setting process, you can't go and state planning the project as the first one, because they are steps. Without 1, you can't go to 2. So the standard setting process starts with an agenda or an idea or a plan. So you should have an agenda before you plan for the agenda. Because if you don't have an idea about something that you want to do, you cannot plan doing those particular things. So one that they have a work plan that they want to bring a new standard into being, then they plan from that project. when they plan for the project, they develop what we call discussion paper for other people to bring out their views on the subject matter. So after planning the project and commissioning people to execute the project, they will develop and publish discussion paper, including public consultation, to fine-tune the standard that they want to promulgate. Step 3 will tell you that, step 4 will tell you that after developing and publishing the discussion paper, they will bring out a draft of the standard that they want to publish. That is step 4, developing and publishing the exposure drafts. Step 3 is developing and publishing discussion paper, including public consultation. Step 4 is developing and publishing the exposure draft, also including public consultation. Now, if the draft is prepared and then it is fine-tuned by consulting the public, then the standard is brought into being. When the standard is brought into being, it doesn't mean that they should start applying the standard. No. They will set a date that the standard will have to be applied, because they have to hold meetings with interested parties and other regulatory bodies to explain to them the new standard that has been set and how it should be applied. So that phase is when they sensitize interested parties and bodies about the new standard. After this is done, before they can issue the standard to be employed in the preparation of financial statement. So these are the 6 steps. It's very important. In the course of our studies, in both financial reporting 1, financial reporting 2, advanced financial reporting, you need these standards. They are very, very important. And almost 80% or 90% of these standards will be done in financial reporting 1 and financial reporting 2. So by the time you finish financial reporting 1 and financial reporting 2, you must have done about 90 to 95% of these standards. When I showed you the course outline, I did mention that in our next meeting, we will be looking at IFRS 13, this one. We will look at IFRS 13. We will also look at the financial instrument, which makes up of 3 different standards. The IFRS 7, IFRS 9, and then IAS 32. Where is it? Yeah, this one. So next time that we meet, you'll see that we'll be going through these standards. Our next meeting again, we will look at IAS 16, property, plant, and equipment. We will look at IAS 40, investment properties. Yeah. And then the next meeting, because today we have done this one, the IES one. You have done this one. Then the next meeting, you look at IES 36 that I talk about. You look at 37 and 38. This one. So you will see that this one is only financial reporting one. This is just financial reporting one. Then when you go to financial reporting two, you'll be doing this inventory, which is very, very important. You do inventory, which is very important. You do cash flow, because I even mentioned it to you. I will do cash flow. You do ISH. ISH, you do that one. You do income taxes, very important. You do that one. You do IFRS 15. Where are you? IFRS 15, revenue from with customers. Yeah, this one. This one, IFRS 15. You do that one. Then this one is part of the IFRS 15. So now look at it, the colored ones. You see, only this one is only level 200 or your financial reporting. Then these ones will be done when you start with your, I think, your advanced financial reporting. So invariably, about 95% or so of the standards will be done with me in financial reporting 1 and financial reporting 2. By your assignment, I told you I'll give you assignment. Let me see. Just give me a minute. I want to share this one and put something on your screen. Just a minute. Let me see. Just a minute. I'll be with you. want to put something there. Just a minute. Can you see my screen? Can you see the screen?
Yes, please. Yes, please.
Yes, John.
What do you see?
IS32. Okay, but the writings are very small.
And that is not what I want to see. Oh, God. It's not showing, but I don't know why it's not presenting. Okay. Now, what do you see?
Fair value
IFRS
measurement.
13. Fair value.
Yes, so the IFRS 13 that I talked about is on fair value measurement. When you say an item is fairly valued, what does it mean? Fair value measurement. So this one will be your assignment. Listen carefully. You read what is contained in this IFRS 13 and summarize it for me. Summarize it with not more than 2 pages. Read what is in IFRS 13. I'll send it to you. You will read what is contained in IFRS 13. Then you summarize it in not more than 2 pages. My email is on the course outline. Then you send it to my email. It is very, very important. Adela, are you on now?
Yes, sir, I'm on.
Where did you go? Course rep, where did you go?
Sir, I didn't go anywhere.
So you were on board when we were starting.
No, I wasn't on board when we started. Please.
So you said you didn't go anywhere. So
Yes,
where
please.
were you?
I overslept.
Ah. I hope you heard the assignment I've given you.
Yes, please. Yes, please.
So I'll make the slide this morning letter to you. I'll send the
Okay.
course outline to you. I will send the
Okay.
ICA manual, I promise, also to you.
Okay,
And
sir.
when is our next meeting? Because it's going to Christmas. I don't know when we are meeting again. When is our next meeting?
There is no break, so we'll still miss next week. Next week Sunday.
Huh?
Next week Sunday, please.
Next week Sunday.
Yes, please.
Well, I don't have any problem. It means I have to get your assignment before Sunday.
Okay, sir.
So I have to get your assignment. And so I'll give you enough time. Because my time is not up now. I'll give you enough time. You can sit down, go through. But I'm sending the information right now to you. Go through and then prepare your response. And then let
Okay,
me
sir.
know. So I thank you very much for this morning. Primpoma, are you there? Let me take attendance and see those who have left.
Yes, sir. I'm there.
Abubakar Anthony. Abubakar Anthony, are you there? Abubakar Anthony, are you there? Since morning, I've called your name, no response. Daniel Mintanya, are you there?
Yes, Prof, I'm here.
Very good. Danny, are you there? Danny? Delali?
Sir, I'm here.
Okay. Prince Wachi?
Doc, please, I'm here.
Very good.
Hello,
Rita
sir.
is there. Yes.
The person
Then-
that responded first for Daniel. Daniel responded in Delali. I am Delali, please.
Yes, I've seen it. Yeah.
Okay, okay.
Steven, are you there?
Yes, Doc, I'm here.
Very good. And then Senna?
Yes, please, I'm here. And you
Very
do
good.
that.
So, yeah, so I thank you very much for this morning. You will
Please, you didn't mention my name. Oh.
What's your name? Rita, I know you are there. That's why I didn't mention. I know. Because you were the first person to enter. So I know that you are there. So there's no problem. So we will meet next week. I thank you very much.
You're welcome, Prof. Have a good week.
Thank you.
You're welcome, sir.
Yep. Hello.
Yeah, hello.
Okay. Please. I want to make some suggestions to the class. Since the course is becoming a little bit cumbersome, can't we have one of the days within the week so that we will use it as our prepping? Then we'll discuss some of the things that they have taught us. Since when you look at the first examination, the exams, most of us, or I don't know the others, most of us were only candidates at our various centers, so that we will abreast ourselves with some of these topics and then our learning, so that when we go and we meet certain questions, it will be so easy for us to answer. Then we all, I don't know whether it makes sense. Please, let's bring our suggestion, I beg.
It's a very good idea. I remember the last block I suggested to the course that if you could form group, but I didn't get any answer. It's a good idea.
I gave you an answer. I placed it in the group, but like it seems no one was interested, so I also let it go like that.
But I think we can do it because what I realized is that the last block, the management too were part of the foundation of accounting. But this one is only us, so we can do it.
Yeah, I have a group for just us, so don't worry. I'll put it in the group again, and those that are interested will just come on board and set a date. Okay.
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 Now,
Okay. So, okay. Okay. Auntie Rita.
yes, dear.
Okay, I'll get in touch with you so that we discuss one or two issues.
Okay.
Okay, then. Delali. Okay.
Yes.
Thank you
Okay.
very much.
Okay.
Okay. Then. Bye.
Oh.